One of the biggest misconceptions among traders is assuming a fixed correlation between the Forex and stock markets. While these two markets do influence each other under certain conditions, the correlation varies. That said, understanding their relationship can indeed help you make informed trading decisions instead of relying on assumptions. In this video, we'll break down the connection between stock market and Forex, what factors drive this relationship, and most importantly, how you can use this knowledge to improve your trading strategies. Now, if you want to trade like a pro, watch this video until the very end. So, what exactly does the correlation between the stock market and Forex mean? Simply put, correlation refers to how movements in these two markets relate to each other. For example, when a country's stock market is booming, its currency often strengthens as well, because foreign investors need to buy that currency to invest in the local stocks. However, this relationship isn't always that straightforward. At times, an inverse correlation occurs, meaning that when a country's stock market declines, its currency strengthens. This can happen due to economic or political factors. For instance, if interest rates rise, investors may pull out of the stock market and move their money into cash or safer assets, increasing demand for the currency. The key takeaway: correlation is dynamic. It really depends on factors such as economic conditions, government policies, and market sentiment. If you learn to analyze these correlations, you will likely gain an edge over other traders. With that in mind, let's explore the key factors that influence the connection between these two different markets. Number 1. Economic conditions. When a country's economy is strengthening or expanding with rising GDP and lower unemployment rates, its stock market tends to perform well. This attracts foreign investment, increasing demand for the local currency and strengthening it. Number 2. Interest rates. Interest rates significantly impact both stocks and Forex. When interest rates rise, investors often shift away from stocks into cash holdings or bonds, making the currency much more attractive. Number 3. Political conditions. Political events can disrupt correlations. For example, if a government implements pro-business policies, both the stock market and the currency may strengthen. However, political uncertainty can push investors towards safe haven currencies like the Japanese yen or the Swiss franc. Number 4. Market sentiment. Investor psychology plays a major role. During economic uncertainty, traders often shift from stocks to safer assets, strengthening certain currencies while causing stock markets to drop. So what is the key takeaway here? These factors are constantly shifting. A skilled trader needs to analyze them in real time to make informed trading decisions. So let's put this into perspective with a real-world example. Imagine the US economy is booming. Unemployment is low, GDP is growing, and major corporations are reporting strong earnings. As a result, both domestic and foreign investors rush to buy US stocks. So what happens next? Well, before a foreign investor can buy American stocks, they need US dollars, increasing demand for the currency. As a result, the US dollar strengthens, forming a positive correlation between stock market growth and the currency. Now, consider what happens if the Federal Reserve raises interest rates. Some investors may pull money out of stocks and move into bonds or cash holdings to take advantage of higher rates. This weakens the stock market, but it strengthens the US dollar, potentially reversing the correlation. This example clearly shows that the correlation between the stock market and Forex isn't static. The deeper your understanding of this relationship is, the better your trades will be. Now that you know how the stock market and Forex are connected, how could you use this information to improve your trading? Well, let's break it down. The first thing you want to do is identify correlations. By this I mean that you should recognize which currency pairs correlate with which stock indices. For example, the S&P 500 often has a positive correlation with the United States dollar, affecting pairs such as Euro USD or Great British Pound USD. The second thing you will want to do is use correlation tools. Many trading platforms provide correlation indicators that show how closely assets move together. If the correlation is above plus 0.7, they typically move in the same direction. If it is below minus 0.7, they often move inversely. Next, you will also want to manage your risk using correlation. So, understanding correlation can help you diversify risk. If you hold a long position in stocks and notice a negatively correlated currency pair moving against you, you might need to adjust or hedge your position. And of course, you'll want to predict market movements. If a stock index makes a significant move, you can use that insight to anticipate currency movements. For example, when Japan's Nikkei 225 index drops, the Japanese yen often strengthens as investors move money back into the local currency. You will also want to combine the correlation with other analyses. So, as mentioned, correlation is a tool, not a standalone strategy. So always combine it with technical and fundamental analysis, including price charts, support and resistance levels, as well as economic indicators before entering a trade. This will help you de-risk significantly. So, in conclusion, the correlation between the stock market and Forex is a valuable tool that can enhance your market analysis and improve trading precision. However, correlation is not a guarantee. Always use it alongside the technical and fundamental analysis tools, keeping in mind factors like government policies, interest rates, and market sentiment. And now that you know the basics of the correlation between Forex and the stock market, I have a suggestion for you. Check your trading platform for correlation tools and analyze the relationship between specific stock indices and currency pairs. If you are a beginner, start by tracking a few key assets, observe their correlation, and refine your strategy over time. If you found this helpful, hit the like button, leave a comment below, and share your experience with using correlation in trading. I would also love to know how will you apply this knowledge to your trading in the future. Answer in the comments below as well so that we can all learn more. Thank you for listening and see you next time.